Welcome to the DWS Market Update. The world is full of unrest. The trade war between the US and most partner countries drags on while we wait for positive developments. Economic and inflation data do not enhance visibility about the economic situation. To add fuel to the fire, the situation in the Middle East and a surging oil price led to nervousness amongst market participants. Nevertheless, most stock indices rush from record to record. The S&P 500 has propelled itself out of its weakness at the beginning of the year and is trading near its all-time high. Many European stock indices even boast double-digit gains since the start of the year. This is also reflected in valuations. The downright resurgence of European stocks has led to a decrease in the valuation gap to the S&P 500 from a record high 45% to 30%. Most recently, however, American stocks have gained traction again. When looking at the continuous evolution of earnings expectations, we see downward revisions for 2025 in both large regions, while expectations are still rising steadily for 2026. Companies and analysts alike therefore expect a temporary economic downturn to be manageable. However, the optimism is less pronounced than at the start of the year. So, we see a hodgepodge of various risk factors, high valuations, and temporarily decreasing earnings expectations. Have stocks reached full potential or even gone beyond? In the short term, heightened volatility and possible market setbacks seem within the realm of possibility, which is why we argue for a more cautious positioning in the coming weeks. However, the prevailing opinion among investors is to potentially use the next downturn in stock prices to increase the allocation to equities. And we definitely agree with that. That's it for today. Thank you for your attention and goodbye until next time.